Hello, everyone. Today, I want to give you 5 things that could actually make the housing market crash. Now, if you've seen some of my recent videos, they have gotten a lot of attention. It's been very contentious in the comments section, and people that have bit on the crash clickbait, they don't like what I'm saying. And what I'm basically saying is that we do expect some slowing of the house market, right? Seeing the supply go back to a 2 to 4 month supply. And with that, the appreciation rates coming down a little bit. And then through the year of 2021, a net appreciation rate year over year of between 8 to 12%. Now we expect that going into 2022 to come back a little bit more as prices go up, and that price appreciation in 2022 to be closer to 5 to 8%. Going into 2023, going back to the norm, and if you know the norm, it's between 4 to 5% year over year. We do expect appreciation to go back to that 3 to 5% going into 2023. Now, in this video, I do want to talk about what are some things that could happen that could actually make the housing market crash, right? Because a lot of times when I get into these conversations, people say, oh, it's going to crash. What goes up must come down. And the thing is, that's just not how it works. But I do want to help you all understand what could happen if certain things happen, right? And so the first thing to mention is that, again, when you look at affordability, right, and the way to look at this is what amount of income is being spent on housing. Now, looking back in 2008 during the peak, we know that people were spending about 40% of their income on their mortgage payments. And that was not sustainable, right? Typically, people pay about 30%. Now, today we're at a 28 to 30%. Now, what this means is, in absolute terms, apples to apples, people would be willing to pay 10 to 15% more in a mortgage payment and still not hit the peak of 2008. Okay, and that's one major thing to look at is, yes, prices are going up, the highest they've ever been, right? Or so it seems. But affordability is not out of whack relative to recent peaks. Okay, and we got to keep that in mind. Now, again, we do think it's going to keep going up to an extent. Janet Yellen, many other people have mentioned that affordability is becoming a sore thumb. We should be watching it. And they're correct. We should be watching affordability because at a certain point, it will plateau. People will not want to pay more than 35, 37% of their income towards housing. They just won't, right? And back in 2008, we had people, bad or not bad, but, low credit-worthy borrowers borrowing, and they shouldn't have been. Right? Credit scores below 600, spending 40, 45% of their overall income on their house, right? Not sustainable. Today, again, the average credit score is 760 that are getting loans. Very solid credit profiles. So a few things, though, that could happen in theory and cause a correction or a pullback in pricing between 10 and 20%. The first one that obviously is really important is the 10-year Treasury note. Now, we know today it's absolutely low. Generally, the way it works is mortgage rates fluctuate between 1.75 to 2.5% higher than the 10-year note. So if the 10-year note is 2%, then typically a mortgage rate will be between 4 and 4.25%, give or take. Okay. Now, I believe, and I think a lot of economists would agree, that if a 30-year fixed gets to around 5.5%, 6%, there will be a substantial pullback in demand for homes. One, because affordability looks closer to like 08 than it does today. And at a 6% rate, I think people will really stop to think about these interest rates, right? That they've been very used to the 3, 4, 5% for many years, okay? Now, what that means is the 10-year note will have to hit at least 3 to 3.5% for us to see that. And by all indications right now, many economists actually see that the economy is going to slow going into 2023 down to the 2% GDP level. We had a really great year in terms of the rebound of GDP, but that's not sustainable. And just an article last week that I read in the journal, I think it was JP Morgan was talking about their predictions of the GDP. We're going to see a slowing of GDP over through fiscal year 2023. So you're not going to see the Fed increase rates substantially to that 3.5%, 4% range because the economy doesn't support it. We don't need money tightening, strategies long term. While right now inflationary pressures are, arguably transitory, from what many economists are saying, we don't need the tightening of money supply yet, right? And so I don't foresee that one being a potential situation. Number two, people talk about these foreclosures that are looming. 2.7 was the number. Before it was like 5 million. Now it was 2.7. Now I hear 2.1. We would need all of those foreclosures to happen at once for the supply of housing to be completely unbalanced. And when you hear this argument, it's important to understand that there are microeconomies within the economy, right? Austin, Texas, for example, isn't going to see 500,000 foreclosures, right? Florida might see a good chunk. Parts of like Memphis, where it's service oriented, might see a good chunk in C class. Vegas, very entertainment service oriented. People lost their jobs. They're behind on their mortgages. They might see some problems. And one chart I want to show here is that there are certain cities that are concentrated in investors more than other cities, right? And in the crash of 08, the cities that had a high concentration of investors were the ones that had the biggest hit in the prices, okay? Well, again, I'm going to call out Austin. This is not one of those cities. Not a huge amount of investors are in Austin relative to home buyers, okay? But my point is that even if the foreclosures come to fruition, they're not going to be evenly spread across the nation. They're going to be in pockets. And so only certain markets will see that extra supply and therefore a dropping of prices. Not all of them, right? Another thing, and one that concerns me, is that buyer sentiment must continually go to the other side. And what I mean is, right now, about 2/3 of people think it's a bad time to buy a house. Now, if that gets to a point where it's 90% of the population, 85% of the population thinks it's a bad time to buy a house, well, then we got problems, right? A good example is that lumber in Home Depot, everyone knew lumber was high, right? So ordinary people stopped buying lumber because they thought it was a bad time to buy. And now Home Depot has a glut of supply of high-priced lumber, and they'll keep those prices high until they get out of that supply and back to the normal priced lumber, normal. And so, again, if buyer sentiment continues to the side against demand, then we could see a pullback. But again, what's going to happen if we see a pullback? Well, we see a pullback. Supply goes, 3-4 months. You're going to see less competitive situations. It won't go from 20 offers on a house. It might be 4. You're going to see days on market go from 5 to maybe 15, 20. And so price relief may come. But as soon as people begin to see the prices drop, they're going to go back out in the market. So if, in fact, we do see a pullback on prices, I don't think it's going to be long-lived. I think people will quickly gobble up those homes. And by the way, there's plenty of investors hoping for the market to crash, to pick up good deals. I'm one of them. I would like to see a crash in certain markets so I can use some of my 1031 exchanges and buy some properties, right? And get something higher than a 5, 6, 7% cash on cash return. So there's that one. Another one is, a Delta variant or another COVID could strike and could slow down the economy in certain states. Somewhat unlikely, but if that happens, we have to consider what that might do to certain markets, like a Vegas, like a Florida. And we'd also have to assume that the states would abide by some sort of, third lockdown to really strangle the economy. But again, to debunk this, I do think the government's shown they're not going to let the economy flutter out. They're just not. They're in a spending mode. If they'd rather have inflation than a collapsed economy and people without jobs. And so those are 4 things that could happen. There's always a war or some sort of crazy cyber attack or some sort of situation that you don't usually hear about that could come about. But generally, the economy is on good footing. The infrastructure bill is going to get passed, so we're going to see a lot of productivity from that. Tech companies have record amounts of cash. They're hiring like crazy. There's a massive amount of need right now for jobs. So there's a lot of tailwinds showing that we have a strong economy. The demand for homes and houses will continue. And as long as debt is, at these historical lows, there's just not a whole lot of headwinds showing that there's a crash looming. Now, again, I know some of you will disagree with me. Some of you think these prices are not sustainable and people will, start running out of their house, selling them at low prices. I just don't see that happening. And I may mention it in another video, but I get this data from very expensive sources, right? I talk to economists and PhDs regularly. I subscribe to a service called Zonda. It's $27,000 a year. It has data from the 1970s all the way through to today, and arguably one of the most robust databases for anything real estate. Those people are training me, they're teaching me, they're showing me what's happening in the markets. I'm reviewing the data. I'm watching John Burns. I'm looking at all the earnings reports from builders. I'm reading the journal every single day. I look for any indication that there's a crash looming because two reasons. One, I have a lot of projects going. I have a lot of things on the roadmap. I'm building resorts in Arizona. I'm building tiny home communities. I'm building homes in general. I'm buying land deals. I'm telling my clients where to invest. I'm doing hard money deals. I'm looking to buy turnkeys in certain markets. I have a lot at stake. So for me to make a mistake and wrongly predict a crash would be catastrophic, right? And so I say these things because while I think it's fair to hear some of these news bits on YouTube, and I think it's fair to take some of the concerns that you see in the headlines and somewhat panic, you really have to break through the noise and look at the data and think about what would have to happen for a crash to happen, right? And again, the general consensus is that I think we're going to see a slow pullback on demand. You're going to see a plateauing of appreciation, but generally it will go back to the 3 to 5% year over year starting around 2022, 2023, right? Now, a lot of my videos I put out there, I talked about 20-some% appreciation from December of 2020 going through 2022 to 2023. And I still believe that. I still think a lot of these markets are going to have a really good 3-year trend when we get to 2023. But I did want to at least talk about what I think it would take to actually have a crash happen. And generally, I just do not see it happening. So with that said, I would love to get your feedback and hope you're all well. Thank you.